Hi and welcome to Swissquote's Daily Market Talk. It's Friday, January 31st. The ECB announced another 25 base point cut yesterday and voiced concerns about the euro area growth. Trump insisted on imposing 25% tariffs on Mexico and Canada. DeepSeek saw access limitations from hundreds of companies on data security reasons, and Apple gained 3% in the after hours trading, and that despite a massive hit from its Chinese revenue. So yesterday was again a big day of news. Investors watched a fresh flow of economic data from around the world, corporate results, central bank decisions, Trump threats, and so we had a few surprises on both the data and earnings front, and the earnings continue to flow in with big oil companies due to report today. But let's start with macro this time if you want and dive in. The ECB cut the interest rates yesterday for the fifth time and pulled the facility deposit rate to 2.75%. No surprise there. The euro even reacted by giving a positive reaction to the news in the first place, but that enthusiasm didn't last beyond the European Central Bank chief Christine Lagarde's presser, where she actually reminded the market and investors that the growth risks in the euro area remain tilted to the downside. But other than that, she just repeated the same old views, meaning lower confidence, rising geopolitical risks due to the Trump threats, the ongoing impact of the past rate increases, and added together hinted that the European Central Bank is inclined to pull more interest rate cuts from its head this year should the inflationary pressures continue to ease, of course. And regarding inflation, Lagarde said that December uptick that we saw caused by higher energy prices was broadly expected, but that the impact of Donald Trump's tariffs and his tariff policies on inflation remain unclear. Because on one hand, the tariffs and potential retaliation to these tariffs will inevitably rise consumer prices on both sides of the Atlantic Ocean, and that would heat up the inflationary pressures for everyone. But on the other hand, higher tariffs would also hit the European businesses, lead to further economic slowdown in the euro area, and tame price pressure. So pick your side. For now, though, the faltering growth story in the euro area overweighs, because growth in the euro area, it couldn't even meet the meager expectation of 0.1% growth last quarter. It came in at 0%, and the annual figure fell below 1% growth. German output fell 0.2% and French output fell 0.1%. And unfortunately, the things don't look right in the Eurozone's biggest economies, with political shenanigans there pointing at continued weakness in these countries' economies. Now, funny enough, the European Stoxx 600 index couldn't care less of what the growth data and political shenanigans suggest. The index actually went straight up yesterday to a fresh all-time high level on rising hope for more European Central Bank support, as the euro-dollar took the direction of the south following Lagarde's presser yesterday, sank below the 104 psychological mark, and will likely remain under pressure below the 104.25, 104.60 area, including the 50-day moving average and the minor 23.6% Fibonacci retracement on September to January sell-off that was heavily explained by Donald Trump's tariff threats, mind you. And even the significant decline that we saw in the US GDP growth update yesterday and the downside revision in the fourth quarter price pressures in the US couldn't prevent the euro sell-off against the US dollar. And elsewhere, Trump renewed his pledge to impose 25% tariffs on both Canada and Mexico, sending also the currencies of both countries lower against the greenback. The USD CAD rallied to 1.46 level and is now challenging the highest level since 2016 and 2020. The risks here are tilted to the downside for the loonie and to the upside for the dollar CAD, as heated trade war with the US could significantly hurt the Canadian economic growth and its economic growth outlook, bring in stronger Bank of Canada support and further weigh on the Canadian dollar. Now, the good news is that the US tariffs will probably not make America great again, which is kind of soothing for the rest of the world. Otherwise, the US would just eat all of us. But the bad news is that it will be a lose-lose situation for everyone, which is probably why we see the gold prices on the rise again these days. So the price of an ounce hit a fresh all-time high level at yesterday's trading session, a move backed by a swift move to safety due to the Trump's tariff threats, the rising geopolitical tensions between the US and the rest of the world, the rising US government debt while all this is happening, and the fear of potential technology rout that could lead to a global risk sell-off. And the move is also probably amplified by expectations or the uncertainty around expectations of central bank policies around the world that become obviously more uncertain with the Trump factor and the Trump dependency and the EM central bank's gold buying in case the relations with the US get worse, and also the shifting that we see in market positioning. Because the latest CFTC data actually shows increased speculative buying in gold since the beginning of January. Well, that was probably partly explained by the rising worries around the high technology valuations, but also the chatter of a sizable downside correction if a potential bubble in technology bursts. The question is, could gold get more expensive, right? Yes, it could. Remember, gold is one of the top picks for this year at Goldman Sachs, for example, because analysts there actually predict that the price of an ounce could reach the 3,000 psychological mark as early as this year. And indeed, a sizable sell-off in global financial markets, God forbid, could drive gold prices to these levels. But the rapid rise in speculative long positions in gold hint that we should, before that, see a pullback in gold prices if the AI worries that were triggered by DeepSeek no earlier than this Monday, remember, happen to be unfunded. And speaking of that, 5 days into the DeepSeek drama, and hundreds of companies, especially those linked to the Western governments, well, they are already limiting the access of their employees to DeepSeek's search engine, highlighting data security concerns for using a Chinese chatbot. Well, that could obviously collect and give information to the Chinese authorities, a thing that nobody wants to happen. So chip and digital information war between China and West is probably entering a new phase, and in this context, cybersecurity firms will likely see the benefits of it. So you may want to have a closer look to CrowdStrike, for example, that beautifully recovered from the July 2024 outage, giving reason to all of those out there who flocked in to CrowdStrike shares at temporarily discounted prices. Then Fortinet, that just hit a record high level as well at yesterday's trading session. Cloudflare, that also jumped 10% earlier this week to a fresh all-time high level as well. And Palo Alto Networks. So these are the companies that have potential for further gains in this context of heating up information and digital war. Speaking of record highs, Meta extended gains to a fresh all-time high yesterday following the announcement of stronger than expected earnings on Wednesday after the close, while Apple gained 3% in the after-hours trading after releasing better than expected fourth quarter results yesterday after the bell and a record high fourth quarter revenue. But wait, it's not all rosy for Apple, because the company's Chinese sales was a massive 15% miss, guys, and the iPhone sales came in 3% below the analysts' expectations. The company's CEO Tim Cook highlighted that iPhone 16 sales have been stronger in markets where Apple Intelligence was available, hinting that there is certainly potential for growth with AI, and the rise in Mac sales and services revenue from Apple services are also encouraging. But Apple looks expensive at the current levels, and this week's DeepSeek push and news of a new partnership with Starlink are probably not enough to justify a sustainable rise from the actual levels. So this is all for this hectic week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.